I'm here today to declare the death of bonds as an investment. It's time you heard the truth. The conventional wisdom is all wrong and it's killing your retirement plan, and you need to understand what how this effect is. I love this actual gravestone because he was the inventor of the Ouija board, which is kind of like bonds, had persuaded us for a while they were a decent investment. So, but now I want to show you the truth, and this is going to shock you, but it's something you need to know. So first of all, let's talk about all the conventional wisdom about bonds. Okay, and I'm going to tell you all of these are false. You probably heard all this stuff, right? They make your retirement safe, they're predictable return, safe, they're safe, they don't lose money, they got historically good returns, they're immune to big crashes, you get kind of a risk-free return or very low risk. And even if you get higher yields, fixed income is safe. You probably heard all those things. They're all false. Now, let me tell you the nightmare scenario. And I see this because I'm a financial planner and I see it long-term. I don't get caught up in the investment short-term thinking, it's the long-term. So here is what I call the absolute nightmare scenario. This is the end of your retirement plan. So here's the nightmare scenario. And what it is, it's the typical financial advisor meeting, right? You go sit down with a typical financial advisor, you do a little chit chat, they give you out a risk tolerance questionnaire. There's no or very little retirement plan for you. You end up with a moderate risk portfolio, end up with a balanced portfolio, and that's it. And it's a total nightmare. And I'm going to explain why that is. So here's the point. You cannot retire comfortably with a balanced portfolio. Now, no one's told you that before, but I'm here to show you the actual facts about it. So, all right, so let's just give some examples. I know there's a lot on this chart, but I just explain what this is. So let's take examples of a retirement plan. You may, even though you have a financial planner, you may not have ever seen this, but here's some actual examples. Let's say you're 35 and you have the average Canadian makes like 50,000. And let's say you want to retire 30 years from now at age 65 on 40,000 a year. You're going to save for 30 years with a 3% inflation built in. So it's whatever the future dollar amount is. And let's assume that you get the maximum government pensions, the old age security and CPP, even though most Canadians don't. But let's just assume that for a second. Now, if you have a balanced portfolio, let's say, so a balanced portfolio, you can buy stocks, bonds, and cash. A balanced portfolio is typically, half stocks or half bonds, something like that. A reasonable long-term rate of return on this would be, let's say, 5% a year. Okay, let's say the stocks do 8, the bonds do 2, or something like that. Okay, so if you make 5% a year and you want to retire on 40,000 a year in 30 years, you need to build up 1.15 million. That's in future dollars for 30 years from now. To get there with a 5% return, you have to invest 17,000 a year. That's 34% of your gross income. That's absolutely stupid. If you make 50,000, you can't save 17. So now let's say all you do is switch over to an equity portfolio. So you're all stocks, equities and stocks are, you're investing in big companies that are growing over time. And just by doing that, let's say you now average 8% rate of return. Now, what you need to retire the same way is 775,000. To get there, you have to put in 6,500 a year. That's 13% of your income, right? So you make 50,000, you invest 6,500. Not easy, but it's certainly in the doable range. So you see that with a balanced portfolio, you just can't do it. So, and the question is, what would you rather do? Would you rather just learn to invest with a bit higher risk tolerance, and it is a skill you can learn, or invest 10,500 more per year for 30 years? What would you rather do? Now, let me show you some other examples. Let's say it's a higher income person. Okay, now you make 100,000, you want to retire on 75,000 a year. This is a single person. So with a 5% portfolio, you have to invest 50,000 of your 100,000. It's just totally stupid. You can't do it. So now again, you go to 8% return. Now you need to invest 19,000 a year. That's 20% of your gross income, right? That's it again, a reasonable number. But 30,000 more you have to invest only because you have a moderate portfolio instead of a growth portfolio. So now let's take a couple. You want to see what a couple looks like. So let's take a couple. They each earn 50,000, 100,000 together. They want to retire on 40,000 each, so 80,000, that's in today's dollars, the future value equivalent of it. Again, saving for 30 years. We're going to assume both get the maximum government pensions. So what they need with a balanced portfolio, a 5% return, they need to save 3 million. And to get there, you'd have to put in 34,000 a year, 30%, 4% of your gross income. Again, that's crazy. That's something even I would recommend as a financial planner. So for most people. Now, again, you just switch over to an equity portfolio. You need 1.55 million, and it's 13% of your income. You have to put in 13,000. If you have a couple making 100,000 together, 13,000, you may be able to do that. So again, would you rather invest 21,000 more, or just learn to invest with a bit higher risk tolerance? So now here's a higher income couple. Okay, 100,000 each. They want to retire on 75,000 each. Okay, so now with 5% return, they need to invest 100,000 a year. That's 50% of their gross income, right? What of their entire gross salary before tax has to all be invested. So, or with an equity portfolio, they need to get to 4.6 million. That's 40,000 a year. That's 20% of their combined income, right? It's basically just maximizing the RSPs a little bit more. So, which is entirely a reasonable number. So this is why you can't have bonds. You cannot retire comfortably with a balanced portfolio, period. And if your advisor has put you into one, they've done a huge disservice, and they probably have not explained to you why this is happening. Now, a lot of advisors, because most advisors don't do financial planning, most financial planners, quote unquote, don't do financial planning, and you don't see this. And if they do a plan, they put in some fake numbers. They'll assume a low rate of inflation. Or what they very often say is, well, when you're 75 or 80, you're going to spend 20 or 30% less. I don't know, do you know people that are 75,000? They're traveling just as much as when they were younger, if they have health and money. In fact, they may do more luxury travel. So the only reason a lot of seniors stop traveling when they're 75 or 80, the main reason is because they never saved up enough money and they're just about out of money. That's why. But that doesn't have to happen to you. You can be a lot smarter than that. So now let me talk about risk tolerance, because we're moving up the risk scale, right? So everyone says you have to live within your risk tolerance, and your advisor gave you this risk tolerance questionnaire. It says you're a moderate investor. So, but what I'm telling you is, so it's, if you think, what is risk tolerance really? It's, it's a kind of a ethereal thing, but really, let's just boil it down. Risk tolerance is the ability to do nothing when your investments go down. So you have investments, they drop quite a bit, they drop by 30%, you do nothing, they eventually recover. And that's, so if you're a person that will panic and sell when it goes down, then you have a lower risk tolerance. Or if you gotta make switches and you can't tolerate having a decline, then you're a lower risk tolerance, and then you cannot retire comfortably. However, you can learn that it goes up and down. Similar, like, for example, I used to be, when I first started flying, it was always very uncomfortable on a flight. I have a bit of turbulence. I was grabbing onto my seat. Oh my God, it's all scary. But, I learned after a while that, that's just turbulence. It's just what happens, and it comes back. It just, you don't have to worry about it. You just ignore it. And the stupidest thing you could do, of course, is get out of the plane when there's some turbulence. You just sit through it and you get there. And what you learn is, there's a little bit of turbulence, but flying is definitely the fastest and safest way to get, to a destination that's a ways away. And it's the same thing with investing in the stock market and equities. And you can learn this. So let's see this. There's all kinds of things. You have to look long-term at history. I'm going to show you just a couple examples to show you that it's actually not that risky when you think long-term. So here is, this is 220 years of data. Okay, let's just look at the long-term and see what really happens. This is just $1 in 1800 would today be worth 1.6 million. Now these are all after inflation. Okay, so $1 to become 1.6 million. It's average 6.8 real means after inflation. So basically the long-term return of the stock market is about 7% above inflation. Okay, but notice this, the red is the trend line and the white, notice how close it has always been to that trend line. Now, you don't experience it that way because, this is decades that you're headed behind and it's an exponential graph. But the point is made that if you stay in over the long term, stocks do well. And so, I show you this because I sometimes get questions from people that say, what happens if, stocks stop becoming a good investment? Let's say we get, I don't know, a bad government or climate change or something. And this is what gives me confidence. So this goes back 200 years, and much worse things are happening than anything going on now. This goes back to, the Revolutionary War in the States, the 2 world wars, several past pandemics when we didn't have the vaccines, right? The Great Depression, and through all of that, stocks kept doing well. And over time, you give them some time, and they're back pretty close to their trend line. And there's a reason for it, because you're investing in big companies that have managements, and whatever happens in the world, they adjust their businesses so that they can get their profits back up. And that's why stocks tend to recover over time. And stocks are, kind of capitalism. It's kind of the reason that all the Western countries are living a high standard of living. So now let's look at bonds. You think they're safe, right? But notice here that you don't have nearly the same trend. So they did well up and down for a bit. And then we had the bond collapse from 1940 to 80. Bonds lost half their money 40 years later. So you have enough money to buy 2 cars, let's say 1950, you have money to buy 2 cars, you buy a 30-year government bond, you wait 30 years, collect all the interest. At the end of that time, you could only buy 1 car. You just lost half your value a whole 30 years later. Utter disaster. Now, the last 40 years are what we call the bond bubble. So bonds have had a huge return, like 4 bonds, right? So they've had actually a decent rate of return, not all that much less than stocks. And, and so what happened is back in 1950, interest rates were like today, about 1%. They went all the way up to 20% in 1982, which is the bottom. And then they came back down to 1%. So what happens with bonds is if interest rates go up, you have a bond, it's worth less because your bond, let's say you have a bond that pays 2%, the going rate goes up to 3, you can sell your bond, but it's worth less. So it loses value. Same thing if interest rates go down, your bond goes up in value. So that's why we had 40 bad years and then 40 good years. All right. Now, anything your advisor shows you about bonds is in the last 40 years. And I'd suggest to you, if you want to look at bond returns, you have to ignore the last 40 years. I know it's a long time, 40 years, but the last 40 years is a super weird time in bonds that's never going to happen again in our life, because the last 40 years, basically interest rates went down every single year, and that's not going to happen from here going forward. Now they probably bottomed last year, and it looks like that from now rates will either stay the same or they'll go up. And you know what? A 30-year bond today pays about 1.5%. Inflation's about 2%. It's even higher right now. So if you buy bonds today, you should expect to lose money after inflation for the next 30 years. So 30 years from now, your money in bonds will buy less than today. The optimistic scenario, maybe they keep up, but that's the disaster of stocks. Now, your advisor has probably told you about standard deviation if they get into risk, right? So standard deviation is a statistical measure of uncertainty. So how uncertain are your returns? Okay, so in the investment industry is entirely focused on 3-year, the definition of risk of an investment is the 3-year standard deviation. So these here, again, this is based on a 200-year study, standard deviation after inflation. So think of it as a picture of risk. So stocks versus bonds versus cash. Okay, stocks over 1 year, 2 year, 3 year, 5 year periods are more risky than bonds and cash. But flash out longer term and look at this. Bonds actually have a lower standard deviation, a lower risk. When you get to 30 years, notice how much lower it is. So what that means is we can more accurately predict where the stock market will be after inflation 20 years from now than bonds. So you think that bonds are safe. So in the investment industry, all looks short term, and they're all just focused on the short term ups and downs of the market. Oh, because you will sell when it goes down, so you have to take these lousy investments. So, but you know what, when you think long term, so we're financial planners, we help you plan for retirement over the years. We're thinking decades ahead. And over that time, stocks are actually the more reliable. They're the safer investment over the long term. I know it's probably shocking to you, but this is the actual fact. So now that is the good news, that stocks are reliable long term and bonds are less reliable. Right? So here's the bad news about stocks is stocks do fall sometimes. So, this is, This is bear markets are when it goes down. Bull markets are where it's going up. And see, this is what actually happened, right? It fell 26%, up 85, up 17, up 81. And these declines are not insignificant, right? 27, 38, 21, 43%. These are big declines. But notice, on average, the market's up 130% over 4.5 years, and then down about 30%, 28% over 9 months. So, but these negative periods, these bear markets, almost all are less than a year. And then we're back into the next bull market, which is much longer and lasts and much bigger than the declines. So you may think you have to avoid them, but you don't. So again, all you have to do is do nothing. Now, that's probably something most of us are able to do. Go watch some Netflix and go look at your portfolio for a little while, and it goes back up. So this is the same data on a continuous graph. And notice that the yellow periods are the declines, the bear market, the gray are the bull markets. And notice it's going up over time. You pick, see, these are decades here. You take any two periods 10, 20 years apart, and you're always way up. It doesn't matter if you're beginning or end or what the market timing is or of a decline. So it just, I can notice it's always reliably going up over time, and that's what you need to focus on. So now this, we call the Stock Market Owner's Manual. It has what we consider to be the 2 secrets to making money in the stock market. And everybody wants to know the secrets, and I'm going to tell you what they are. So first of all, when the market's going up, when it's these gray periods, when it's going up, get all of the returns. So we're always focused on, trying to get more than 100%, trying to get more than the index in the bull markets. So, and now that may not sound like a lot, but we just had the longest bull market in all of history, March 2009 till March of 2020. There was 11 years with not even a single decline of 20% for the whole 20 years. It basically went straight up. And in that period, basically every day there was another article from someone in the investment industry saying, oh, it's been a long bull market. You got to get more cautious. And they always try to guess when the next bear market is, and they're always getting more cautious. And you know what they're missing? They miss the growth. So for us, we have no idea when the next bear market will be. There will be one, but we don't know when. And we don't think it's worth trying to guess. So it's going up. We got our foot on the gas. We're going to get 100% or more of the gain, even after fees. We're just going to get that gain. And that's the one secret. So now the other secret, so 90% of the time things are great. Then occasionally stocks go down, and we don't think of it as a decline because we have this complete confidence the market is going to be up long term, right? So we think of these as buying opportunities, and they are. Whenever if you have a broad diversified equity portfolio like the stock market, every decline, the market has recovered from 100% of declines in the past. So when it goes down, it's going to recover most of the time pretty quickly. Most of the time within a year or two. Sometimes it may take longer. But while it's down, don't think of it as down. Think of it as, what, this is a buying opportunity. All the money you invest while it's down will get a higher rate of return than all the investments you invest when it's not down. So So the attitude that makes you a successful investor is 90% of the time the market's going up and you just got your foot on the gas and getting all the gains and more. And then 10% of the time the market's down and market's on sale and you've opportunity. So is there a way to take advantage of it? Can you put more money in? Is there some way to take advantage of it before it recovers? And that's the attitude that makes you a successful investor. The entire investment industry is always short-term focused, fear-based. Oh my God, you got risk tolerance. Oh, it's going to decline. You know what I mean? And you're going to panic and sell. No, but you're not. Are you really going to panic and sell? You can just do nothing and stay with it long-term. And see, that's the only way you're going to have the retirement that you want. So let me just show you the difference in view. So this is 1-year returns, 150 years of data. This is how the investment industry looks at the stock market. Okay, it's pretty unpredictable over 1-year periods. All right, it's pretty big shotgun look. Now, here's as financial planners, we look long term. This is how the stock market looks to us. So it's always done, 5% a year or more it's over 25-year periods. It's always done that much. And, this is kind of the modern stock market here, since before that it was all basically farming stocks and railways. But the modern stock market here started here like the late 30s, or late 1920s, so 25-year periods ending in the 50s. And the worst 25-year period of the last 90 years of the modern stock market is 7.9% a year, 8% a year. So 8% a year, after 25 years, you have 7 times the amount of money that you have today. So that's really the whole secret. So you just think of it a long time and look how reliable it's always done well over 25-year periods. So let me shoot down all these wrong beliefs. So first of all, people may say that bonds make your retirement safe. They don't. You cannot retire comfortably with a balanced portfolio, period. So, and the people who don't know that are the people who haven't done a proper financial plan. Secondly, they say it's a predictable return, but remember we had the 40-year bond collapse and the 40-year bond bubble. That's ridiculous. It's not predictable at all. So now they're safe. They say they're safe and don't lose money. Remember, from 1940 to 80, there was a 50% loss after inflation. Like not a decline it came back from. Like for 30 years later, you're down 50%. So after inflation. Now they say historically it's good returns, but that's only the last 40 years in the bond bubble. So, from 1900 to 1982, 80 years, bonds made zero after inflation. They made zero. So that's Canada, that's US, that's global. It's the same number, zero after inflation. So, and that is the normal return of bonds is, zero. Sometimes it's, it's been long-term about 3.5, but, considering we're now at the end of a bond bubble and rates are now at the low and going to probably rise over time, you should expect to make zero or less after inflation for the next 30 years. So they say they're immune to huge crashes, but 1918, there was a 26% loss in bonds, a 1-year loss. So it still does happen. So the idea of a risk-free return, I love the quote from Warren Buffett. He calls bonds today return-free risk. There's really no chance that you're going to make any money. And if interest rates rise, you'll lose money. So there's lots of risk, no chance of return. So, and there's a tendency to be, well, bonds are yields are low, so we'll buy other kinds of fixed income that has a higher return. But anything that has a higher yield, the big search for yield, anything with a higher yield has risks, and you have to make sure you understand it. And the entire subprime mortgage crisis was all based on this. Rates were low, and people were buying these things that they thought were bond portfolios or a money market. You know what? And they didn't understand the risk. So it's when they get into higher risk, you actually get into it, or higher returns. It's actually much higher risk. So today, yield on a 30-year bond, 1.5%, inflation is 2% or more. So you should expect to lose money for the next 30 years. It's a truly horrible investment. That's why I'm declaring the death of bonds as an investment. Think of bonds as money is parked, not invested. And what I suggest to you is learn to have a higher risk tolerance and invest in equities. And to the extent that you can't, or that you have money that you need, shorter, medium term, put it in cash instead of bonds. Put it in a high interest savings account or a short term something. So something that then it's clear in your head that it's parked. If the money's in bonds, you have a tendency to think it's actually invested, but it's not. So so bottom line is, as a financial planner, we're to care about your long-term, your retirement plan, your long-term, and that you're financially independent over time. And what you need is a real financial plan. So if you have a real financial plan, you're going to see the effect it has of having bonds and having a bit higher rate of return. And we do what's called an interactive plan. And really it's a life plan, not a financial plan or retirement plan. So an interactive means we can go through a whole bunch of different scenarios for you, 5-10 different scenarios, all within seconds to show you. So what happens if you invest a bit more money? What would you have to do to retire a bit earlier? What you're doing now compared to the retirement you want. Are you on track? How much more would you have to put in? Where would you get that from? And then we work out a very detailed lifestyle, now what you have now and what you have after retirement. So if I, for example, if I invest another 3,000 a year now, then I get, 2 trips, like I get more trips, 20,000 a year instead of 10,000 a year for travel after I retire. And when you see these differences, you can actually make a real life choice as to what's more important to you, have some money today or the more comfortable retirement. And my advice is just avoid bonds. Focus on equities to the extent that you can. 100% equities is the ideal, but you have to be within your risk tolerance. But you could learn to have this higher risk tolerance, and it's a learned skill, just like learning to fly on a plane. You can learn to have this skill. So, all right. I hope you find this really interesting. If you want to have any comments, you can just send a note on my blog, or if you want to talk to us, my blog is edrempel.com. It's actually the #1 blog in Canada for a financial planner. And it's because we have this unconventional wisdom of what really works. So if you want to talk to us, just fill out the contact form and ask for a free 30-minute consultation. And one of our planners will talk to you. So, all right. Thanks a lot for listening, and we'll talk to you soon. Bye.